And while all commodity prices will rise, and due to the effect of 50 years of siloed COMEX price suppression, silver has become the most undervalued commodity on the planet Earth, bar none. I don't think many people dispute that. There's a huge divergence between what you're seeing on the charts here and what's really going on. And there's no doubt in my mind, though, that the elephant in the room, let's deal with that first, is the mainstream media ignoring the commoditization of the ruble and its impact on the precious metals market. Let's look how nickel-like the silver derivative market really is at this juncture. Now divide one into the other and we arrive at a widely accepted leverage of 250 to 1. In other words, there's 250 ounces of paper silver underpinning each ounce of physical that's been pledged. If the price of silver was based directly on the real physical silver market at 250 to 1, silver's price should be at $5,000 an ounce right now today. So what does it mean? Now, when this derivative blow-up happens, and by cracky it will occur in the physical market. And it'll not spring out of the COMEX, the CME, or the SLV rigged machine. They will be impacted, but it won't come from there. Because that's where, if you remember, that's where the Hunt brothers got rinsed, like any other paper speculator, because the silver was borrowed from the house. The house never had any silver, and the house called in the credit. End of story. So SLV has proved itself to be a derivative flywheel. It's very vulnerable. And one must remember, the nickel black swan event was a direct reaction to Russian sanction blowbacks, unraveling leveraged short bets that were exposed to physical demand. They blew up, sparking the LME to go on record. And I remember the quote clearly in my head: "It has no direct visibility of over-the-counter transactions and positions," end of quote. I remember that. The latent beach ball effect in heavily capped silver is going to be even stronger. Now, technically, fundamentally, and structurally, capping silver into a known large over-the-counter options expiry is undoubtedly related to the squaring up of a very large chunk of the naked short portion of the recorded multi-billion-dollar OCC derivative position we've been tracking and going public on. The unprecedented reducing of loan values to actually allow the insiders to actually provide them liquidity to provide more shorts at the Rubicon line. However, with no spec longs left to rinse, and clearly there aren't any, and now there's only a massive ballooning naked net short spec position, creating layers to rinse to the upside. There is almost as much accrued short cover for these insiders by just to target multiple spec short stop layers to the upside, i.e. if they're short, you need a stop. So it'll be above the market. Now, given the silver OCC European bets, the break-even point is assessed at $23, and dips below 22 have forced widening backwardations to futures. You can see it for yourself. To sum up, following the April 18th CME stick save, the overshoot of the silver futures 26,225 Rubicon line, and it topped out at 26,495. The silver over-the-counter options positions were squared yesterday a full $5 lower than when they started. It's been lower than that, but they squared it $5 lower. Now this has pushed the physical paper divide to extremes, and insiders will be capitalizing on every spec short sold position. Now the only question, guys, is, as we usually say, how much physical do you personally own? Now it's going to become increasingly difficult for the mainstream media propaganda machine to gloss over that the strategic commoditization of the ruble is now firmly underway. Now, while this has far wider and in some jurisdictions devastating and economic market implications as far as gold's concerned, and in particular silver. What this means is that the market-making first-tier bullion banks facing the lion's share of a multi-year accrued quadrillion-dollar derivative position, not all gold and silver, but it's a derivative is a derivative, and not let's forget that the 15 trillion a year over-the-counter gold market is the anchor for this deck of cards with this derivative iceberg, basically. And it's these same first-tier banks are now scrambling to position for higher commodity prices, which is going to force a strong bid under all physical markets. Now, silver is, as he says, the fuse to break the financial system. And by crikey, is it lit. Silver is such a tiny market. Its global production is, what, less than 20 billion a year? And when a physical call on silver is made into a multi-billion-dollar net short derivative position, there is no silver to back up these over-the-counter positions. Now, paper silver hedges paper silver. That's the game. And given silver also trades as a deliverable foreign exchange cross against the dollar and is joined at the hip to the directly related deliverable FX gold market, a call on silver for delivery will break the financial system if the banks on the hook are not bailed out. There is deliberately very little information published about the silver derivative market. Nothing has changed. And now, here we go, the black swan fallout begins. Now, if you just look at the numbers here, then, you know, again, it's worth looking at. There was 300 tons. There's one entity had bet 300,000 tons short nickel at an average price of 18,500 a ton. When it blew up, it spiked 250% to 100,000 per ton as these margin calls hit. And had the market not been officially rescued, the sharks would have circled, and the too big to fail liquidity providers would have faced another Lehman moment, because they sure as hell didn't have the product. Now, at this point, before you even ask the question, let me make it a very critical point here. While it was and is possible to halt trades in the siloed backwater of the LME, or the COMEX for that matter, but silver is a global foreign exchange currency cross alongside the dollar, the euro, the yen. So no such market halt could be instigated without causing all the too big to fail over-the-counter liquidity providers to crash and burn. The March 2020 EFP blow-up that we talked about multiple times would be minuscule in comparison.